All right, everybody, we're going to go ahead and get started today. I think everybody's online that we were expecting to be on today, so appreciate everyone joining us. My name is Pat Walsh. I'm a partner here at Oxford, and with us on the other side of the screen is our managing partner, Eric Chrisman. So appreciate everybody coming on the line today to talk about investing and managing your money during this pandemic. So we ran a similar webinar to this a couple weeks ago and had a lot of great questions. Looking forward to following up on some of those, and also we've had some new questions submitted for this round. So with that, I'll turn it over to Eric just for a brief introduction, and then we'll get into the questions.
Thanks so much, Pat. Welcome, everyone. Really appreciate you all taking the time to join us today, and hopefully we'll get through some questions that will be of interest to each one of you. One quick housekeeping thing. I'm having some really bad internet connectivity problems of all days, so it is entirely possible that I will just disappear from the screen, and at that point, Pat will just jump in and pick up the rest of the sentence because we work together so much that he'll probably know exactly what I was going to say anyway. But so I apologize in advance. We can't control the technology, and thought we had a good connection worked out, but we'll see how this goes. So thank you for your patience in advance on that. As Pat said, we did one of these sessions a few weeks back, and it was a really good chance. At that point, we're really deeply in the middle of news of the pandemic spreading. And obviously the stock market reaction at that point had been a 30% drop. And we were in a pretty tough environment. Not that we're in a really easy environment now, but we have a little more, probably a little more clarity and perspective on where things might be going in the future. And those are definitely topics we can talk about a little bit today. But 3 or 4 weeks on, I know we've all been trapped in our homes for a very long time, and we've made the best of it. And I've been really amazed at the response just nationwide and how folks have handled this, the adjustments we've all made to our lives. And I think this isn't great news, of course, but we are starting to see some positive signs out there, particularly on the economic front and obviously on the health side as well. So we'll talk through all those things today. We don't really have a preset agenda for topics we're going to cover. And I would, as Pat said, really encourage you all to use that little chat feature. And there may be something that comes up that you haven't thought of as a question yet. Just go ahead and type that in, and Pat will field those as we go. So with that, Pat, what's one of our first questions? Oh, Pat, you're on mute.
That might help. So you touched on a little bit with some of the advances that we've made recently, even just over the last several weeks on the economic and on the medicine side. So just kind of a general big picture question. So your overall thoughts on kind of where we are, what might have changed in your opinion from where we were 6 weeks ago to now. Common question we've gotten is, are we overreacting to things? Are we underreacting? And kind of how do you see all this? No one has a crystal ball, but how do you see all this playing out over the next several months and throughout the remainder of the year?
Gee, that's just like 6 questions all wrapped in one there. And as you can imagine, these are things that we've obviously been in contact with our clients here in the last 6 or 8 weeks as this thing has unfolded. And these are questions we've had come up quite a bit. And they're great questions. And as I said, there are several questions and sub-questions buried in there. I may just try to take these, break these apart a little bit in terms of things that we've been asked and what our take is on that. First of all, on the medical front, and I am no scientist and I am no doctor, so anything I say may be somewhat misinformed. But I think the response, both trying to keep the politics out of this, but if you look at collectively at how the world's responded, how the nation's responded, I think we're going to see, I'm kind of going off tangent a little bit, when we have significant external events that take place, things that no one saw coming and that we may or may not have been adequately prepared for. This country is amazing at having just kind of this pioneer spirit at saying, okay, we have this thing that we have to deal with now. How do we put all of our resources against this and try to solve something that hasn't happened in 100 years, quite frankly? And I think we'll see 2 years, 3 years, 5 years from now, I think we'll see some unbelievable new skills develop on the medical and pharmaceutical front that maybe we had the seeds of at one time, but having a crisis forced it upon us. So much more rapid development of drugs, hopefully some loosening up by the FDA in terms of bringing new therapies to market for treating a number of things, not just the virus we're dealing with right now. Viruses do change over time, and we'll deal with this one, but there'll be others. There always have been. As long as there have been humans around, there will be more viruses coming at us in the future. But our ability to rapidly deal with something that comes up and come up with therapies and get those in the market. I just saw something yesterday. It was amazing. They just concluded a trial, and again, it was fast-paced or fast-tracked by the FDA in a way that never would have happened otherwise. 5,000 people who have been infected with coronavirus, and pretty. I mean, these are pretty serious cases. These were people who have been given, they've been on the ventilators, they've been given whatever drugs they thought would work, and still were having serious problems. They all volunteered to receive transfusions from folks who have been exposed to virus and have gotten past it. So not something the FDA normally is very keen on doing, but they said, let's do this. And the preliminary results they got from that are pretty amazing. So it's something I think the medical community anticipated would probably go okay. But in times of crisis, you get to do some things you probably couldn't do otherwise. And so I just think there'll be a lot of things that come from this that when we look back on, we'll say, oh my gosh, we have been able to really take our knowledge base and our ability to respond to a whole new level. So that's just kind of a quick thing on how things can go on the medical front. We're certainly not out of the woods, but it's encouraging to see that we've been able to just really engineer so many new things as a result of this crisis. On the economic front, the damage that has been done to the economy is almost unprecedented, and the fact that we collectively made the choice, because we could have chosen to do it differently, but we collectively made the choice to really take a pretty big hammer to the economy in order to save lives is a pretty amazing sacrifice that millions upon millions of people have made. And the economic damage from that, we're seeing obviously just numbers that we've never seen before in terms of unemployment claims. They've never been like this before. As best as they can estimate that during the Great Depression, they didn't have stats on this necessarily back then, but they estimate that during the Great Depression, about 25% of the workforce was out of work. We're right now at 16%, and most estimates say we're going to top out at 20%, which is we've just never even come close to that in any other time period other than the Great Depression. So these are pretty dramatic things are taking place. At the same time, we're also seeing some states and cities that are moving forward to open up the economy again. And I'm sure you've all been out at grocery stores and depending on where you live, have seen a lot of different approaches to making this work. And I think that's probably the right way to do it, is to let some local places try some things, and we might get different experiments in one city versus another, and maybe we'll learn some things from that as to what really works and how we can go back at this again. So on the economic front, a lot of damage has been done. No doubt we're in a recession right now. How long that will last, that's something that's not quite well known yet. The fact remains, people want to go back to work. People want to support their families. They all the stuff with the unemployment benefits. Let's hope that that's a really short-term thing, but I don't think that's how most Americans really want to respond to this. They want to get back to doing what they were doing before and do good, productive work and support their families and support the community. So I'm confident that we will see the economic side of this turn up faster than maybe you guys are hearing in the news right now. As we all know, the media likes to tout the bad news because bad news seems to travel faster and gets more attention. I'm a little more optimistic than maybe your typical news reporter than as far as what we're going to do and how quickly we'll come out of this thing. Did I answer some of the questions in there, Pat?
It does. I think the last one, just kind of a tie on that. Again, no one has a crystal ball, but if you could talk a little bit about at least historically, the reaction of the market ahead of the economy, and what might the market recovery look like relative to, again, obviously the economic piece has a pretty wide bandwidth of how much time it might take for get everybody back to work and everything, but how you might expect the market to react to some of these things opening back up and moving forward.
Yeah, this is another one where I'm not a big fan of most of the media. If you look at what their job is, you'd think that their job is true journalism. Research things, get the facts straight, present a balanced view. Unfortunately, you don't see much of that out there, and we haven't for quite some time. And so we're fighting this negative tide all the time where the media will say, well, look how many people have lost their jobs. How could the stock market possibly be going up? They're not the same thing. The economy, no question, is just being decimated right now, and people's lives are being upended from an economic perspective. That's if they were affected on the health side. And so, these are awful things, but these are things that will pass, hopefully sooner rather than later. But this is not a permanent change to the makeup of the American economy. It's just not. If it were, then you would see the stock market, which is a forward-looking instrument, not backward and not even current, it's forward-looking. If this were a permanent change where the country's productive capacity and GDP and unemployment are always going to be as bad as they are right now, then the stock market would look very overvalued. But the reality is we will come out of this, and the stock market's already looked ahead on that and said, if you take the 500 largest companies in the United States, which make up the S&P 500, and you looked at all of their future prospects, are they going to be able to make anything, sell anything? Will they pay dividends to their shareholders? Obviously, the answer is yes. And those things have not been permanently disrupted. And so if you look ahead to those and say, well, really, when you buy a stock, it's as simple as saying, what will I get from owning this stock? I get dividends, and I hopefully can sell the stock at a higher price in the future than I bought it for today. That's how you make money on stocks. And so if we believe that stocks, these companies will never go back to where they were, and that the economy is shrinking, it's never going to be the same again, then yeah, stocks will be overvalued. But the media conflates these things and takes any bit of bad news and says that must mean that stocks are overvalued. It's simply not true.
All right, makes sense. Question actually just came in, sort of related to one that was previously submitted, which is, there's a lot of change going on, a lot of change on the economic front, a lot of change on the market front. So someone just asked, how have our clients reacted to some of the changes going on, and have we been proposing any changes to client portfolios, or should I be making any changes to my portfolio in reaction to what's gone on over the last several weeks and months?
Yeah, and I think this is another one where this happens when there's good news as well. Get back to the late 90s when the dot-com stocks were all the rage. And, everyone looked at it and said, my goodness, my neighbor he just told me he made a killing on some, pets.com, were the ones that flamed out with the sock puppet, going back a few years to showing my age. But this idea that I should be doing something, either there's a bunch of good news out there, or in this case, a lot of bad news. I guess I should do something. And it's a natural reaction to have, but it's not the reaction you should have, because portfolios are built, first of all, they're tied to goals. And so if you're going to decide to invest, that is not a day-to-day decision. That's not a casino type of decision. It's a long-term decision. You probably have long-term goals, and you may need a portfolio to help support those. You need the growth that the stocks can give you over the long haul. So if you have a goal that's 5 years out, 10 years out, then you would put a portfolio together that would reflect what may happen in that time horizon with the markets. And over a 10-year horizon, you can be fairly confident, and I can't say guaranteed, but over 10-year periods, I think if you go back and look at the last set of 10-year rolling periods, 77 out of 79 10-year periods, you would have made money in stocks. And so when you look at it that way and say, okay, if I've got a 10-year goal and a 10-year horizon, I shouldn't have to make any changes to my portfolio just because this happened. The reality is that about once every 5 years, on average, the stock market has a very big negative event. We call that a bear market. Definition of a bear market is stocks dropping 20% from where they were. And actually, on average, the drop isn't 20 when we go into bear market, it's actually 30%. And lo and behold, that's exactly how much stocks went down in this last episode. Again, very unprecedented thing that took place, and the reaction of what we did to try to slow this thing down was also very unprecedented. We've damaged the economy in doing so. But it's not an unusual event, historically speaking, from a stock market perspective. And so the answer to the question was, do Oxford's clients, have there been a lot of changes made? The answer is no. The reason is we knew that something like this, we didn't know exactly what it would be and when it would happen, but we knew these things come up with some regularity. And so the portfolios were built in anticipation of this type of volatility rather than a reaction to it.
Makes sense. All right. Question actually specifically about some of those goals. You mentioned, portfolio should always be tied to a goal, either a short-term goal or long-term goal, most of which obviously retirement's a big one out there for pretty much anybody. We all aspire to retire and quit working, or at least be financially independent to do so at some point. So if you had any, I was planning on retiring in the next couple of years, how might that affect that goal? And, is there something I could have done in advance to make sure that my goal stays on track? People that are inside that 3 to 5 year window, what can be done in advance of something like this happening to make sure that that retirement goal, stays on track?
Yeah, a great question. And this nuance becomes important, particularly if you're coming up on something like a really major event like retirement. So, if you've got 10 plus years before you are needing to draw these funds out, generally speaking, you can have a pretty high percentage of stocks in a portfolio and expect that will serve you well and help build wealth over time. As you get closer, though, as a year goes by and 3 years go by, and that goal that was 10 years away is suddenly 5 years away and 3 years away, it is appropriate to strategically adjust the portfolio as you get closer to the time in which you're going to need to draw those assets out. We personally have a big belief that 5 years is kind of the magic number. What I mean by that is once you are in a window where you're within 5 years of needing to start withdrawing dollars to live off of from the portfolio, then it is appropriate to adjust the portfolio and go to a little more conservative stance. We also feel very strongly that stocks over the long haul do provide a really nice lift to portfolios, and so there's an appropriate role and a balance between what we'll call stability and growth. As you get closer and you're within 5 years, we don't believe in taking any risk with those dollars that we know are going to be spent out of the portfolio within a 5 year horizon. So we would call that our stability bucket. And in that case, what you should be investing in are really super safe liquid things. So cash, money market funds, bank CDs, maybe some short-term bonds that have defined maturities, but really trying to keep that stuff very safe and not subject to volatility. Once you have built up that war chest and you have 5 years of your upcoming withdrawals already set aside and protected, then the rest of it can be invested for growth. And what you do as time goes by, you just keep taking a look at that mix and making sure that it's appropriate. So if you're within 5 years, probably time to make some adjustments. But beyond that, you have this opportunity to get some of the stock market growth, but understand that comes with volatility as well.
Similar question, kind of piggybacking on that one. Somebody wrote in, I'm already retired and living off of my portfolio. Is this recent event a reason to stop or lower my distributions from the plan that I was on?
Again, sometimes it's difficult to deliver specific advice when not knowing all the facts of the case. I can only speak to how we manage this with our own clients, and so we do. First of all, we have a really good written financial plan for each one of our clients. And so if we have someone who's in retirement, we already have all the forecasting done. We know exactly how much they're going to spend each year. We know how much to withhold for federal and state taxes, depending where they live. We know what the outflows are going to be based on their tax bracket and what their spending needs are going to be. So knowing that and having that written down and revisiting that with the client each year, that's how we stay abreast of what the portfolio needs are going to be. That then dictates how the portfolio should be built. So the financial plan drives the investment plan, and that guides us on what we need to make happen for them. Since we've already done that and we know what the next 5 years of spending are going to look like, we see no reason why a client would ever have to tighten the belt, so to speak, in a situation like this we're having. We knew that something bad could happen. We already planned for it. I don't see why the client should have to be penalized or again tighten the belt and live on less just because the markets are having this type of a route. There may be other advisors who handle that differently, but it's been my experience that people don't like taking a pay cut. They get kind of accustomed to living on what they have, and it just doesn't seem right that they should just be told, "Well, sorry, just not enough money there for you now. You better dial it back." So we personally don't like to do it that way, and we've had a few clients in situations like this who have come to us and said, we were thinking about taking this trip, and I think we're going to hold off on that now. And we'll say that's fine. I mean, that certainly is a very conservative way to go about it, but we're not telling them that they should cut back in times like this.
Next question. I'm not sure if this is framed from somebody that actually got out of the market because of some of the events, or that maybe they just have some idle cash in the bank. But the inevitable market timing question, which we all know that we can't do. What is the right time to put idle cash back to work? Again, either if it's after a decision you made in a panic, or if you just have some extra cash laying around in the bank. What's the right time to get back in, so to speak? And would you recommend doing that as a Another question I've seen is a lump sum, or is it, should you, layer that in over, invest the money every couple of weeks or every couple of months according to a plan? Kind of what are your and our thoughts on that?
Yeah, and Pat already alluded to this a little bit. We firmly believe that trying to time markets is a fool's errand. We are aware of no one who has that crystal ball. We are aware of no strategies, no research that would indicate that there is any way to predict times to buy into the market and times to get out of the market. So it's something that we call a bit of a siren song. The allure of that is very strong, and it'd be great if we'd be able to pull that off. We just know that all the research says that's not a strategy that works. So knowing that, you come back to the idea of let's prepare for this in advance. Let's know what our needs are going to be. Let's plan for those. Let's document them. And so when these things come up, it really becomes a different conversation, Pat. So if someone says, I think I want to put some money into the market, when should I do it? If we assume that we've already done the planning work and had the conversations about what the money is for, I would say the time to do it is yesterday. Because if you really do have that idle cash, there's no need for it. Put it to work. And don't try to say, well, I'll do some this week, or then I'll wait until things look a little bit better and I'll put some more into work. Do it yesterday. Just get on with it. Because trying to time it will not work. If putting it all in at once this doesn't sit well with you, then at least take a systematic approach and say, I'm going to do a third, a third, a third. A third now, I'll do a third in a month, and I'll do another third a month from now, and fix it and forget it. You can set up automatic account links from a bank and do transfers, and it's important to take the emotion out of it, because there will always be something that will come up in the news that will make you say, oh, I wish I had done that a day earlier, or it'll something come up and say, I'm really glad I didn't do that. I would have lost all that money. It's just the framing of that question. It can be dangerous at times. Just make it happen, move forward, don't look back.
That's good advice. All right, we've got a couple more, I'll call them kind of big picture economic questions or general questions. So how do you think this pandemic might affect some other markets, such as real estate, housing, things like that? Any inclination there?
It's funny. You get a lot of opinion and start asking questions like this. So, boy, that one, getting just too far off track here. I've actually been in contact with some commercial real estate brokers, and I've got a place, a personal home that's on the market. So this real estate thing is very top of mind for me, and I think I think there are a lot of opinions, and I think there's an article in the Wall Street Journal even today talking about what's the future of work going to look like, and I think they're writing about it from an office environment standpoint, but it could be factory floor as well. There will be a period of time where we're going to continue to make a lot of adjustments, whether it's masks and distancing and all of that. People crave, I'm sorry, we're social creatures. We crave this opportunity to be around other people, and that is ultimately how things get done. We have to have direct contact with other human beings, and there's tons of studies that shows from our physical and mental well-being we need that. So, it'll be weird for a little while, but I don't think you're going to see office buildings just go empty because everyone's going to telecommute now, or whatever the new word for it is. It's just, I'm sorry, it's just, it's not realistic to think that that's how it's going to go. Will there be some adjustments? Sure. I think there'll be probably more people that if they are in a type of job that allows for it and the company allows for it, there'll probably be people who work from home a little bit more. And there may be some really innovative things that come from that. But in the end of the day, we have to get back to being around each other again. We have to be comfortable with that. And, I, for one, am looking forward to that happening as soon as possible, but also being respectful of what we need to do from a protecting people's standpoint as well.
Yeah, I agree on that. I like working from home a little bit and get to see my family a little bit more, but I miss our office camaraderie a little bit. So I'm looking forward to getting back to that when it's
well, and we've talked about this internally as a team. I actually, for the last about 7 years, our whole team is based in Cincinnati, except I was the odd duck. I was actually living in Denver. And so for 7 years, I've been living that life, working out of a house, at least when I wasn't on a plane, and doing face-to-face business with clients. And we've tried some of the video conferencing thing in the past, and just regular phone calls to do some meetings with clients. For the most part, though, our clients prefer to meet face-to-face when possible. Will we end up doing more video in the future, assuming that internet doesn't break in my house? Yeah, I mean, if that's convenient for people and they would prefer that to having to hop in the car and drive down to an office and find parking, then that's great. We're happy to accommodate that. But I think for the most part, people still prefer to be together. And I firmly believe that something happens when you are in a work environment. I think your mindset shifts to I'm at work, I'm going to do work things, and I'm going to be efficient and get this done. And then when I leave here, I'm just going to leave it all behind, and I'm going to do home things when I'm home, be around my family, be fully present with them. I think if anything we've learned here in these past 8 weeks, how important it is to really make sure that we're spending our time in the right places and with the right people. And, so maybe an appreciation for that. I like that separation between home and work, but I've lived that for the last 7 years, and maybe I've got some bumps and bruises from doing that.
Next question is kind of another big picture one. Obviously, the economy's been kind of pumped full of the stimulus and things. Obviously, well needed because of obviously the forced government shutdown. Obviously, there's new stimulus bills coming out, and that's added to the debt. Do you think that'll have an effect on taxes in the future as far as how to cover this temporary time where we've had to kind of pump the economy full of liquid cash to maintain liquidity?
This is one that. Again, try not to get too far in the weeds on this. I'll start by saying that, one, I'm pretty fiscally conservative. I like to make sure that we aren't writing checks that we can't cash. So, conceptually, I don't like seeing massive amounts of centralized control and spending coming out of Washington, because Washington doesn't always, and sometimes not at all, doesn't always make the best decisions about how those dollars get spent, because it's not their money. It's our money. And so I think there's a lot of waste in the system, but that's not a new problem. But our country's collective ability to finance massive expenditures is greater than any civilization that's ever been seen before. And so while I am aware of the national debt clock that's in Times Square, New York City, and how much that thing is running all the time, if you look at what we owe compared to the sum total of the productive capacity and assets we have as a country, our balance sheet's pretty darn solid. It should be better. I don't like that there's so much uncontrolled spending, but we really are in a good spot. It's no different than looking at your own personal balance sheet and saying, well, gosh, I have a mortgage, and if I take out a bigger mortgage, my goodness, I'm going to go bankrupt. Well, maybe. But what if you just got a huge promotion, you're making twice as much money, and your mortgage is only 5% larger? You actually are still way ahead. Your balance sheet's even better than it was before, despite the fact that you took on a little bit more debt. And I think that's the best analogy I can come up with in terms of what the United States is doing. We are adding more debt to the balance sheet right now. And, will every one of those dollars go someplace productive? Obviously not. Will we look back on this and say it's a good thing we did it that way? I certainly hope so. But it's on the asset side of the balance sheet, we're still incredibly strong. And as long as we continue to be innovative, which I think we always will, as a society, I think I don't have concerns about the U.S. balance sheet. Are taxes going to have to be raised because of this? There's actually a pretty loose relationship between taxation in this country and the balance sheet of the country. Taxes are anymore almost a political thing, more so than just an economic thing to say, well, we suddenly have to raise taxes because of this. You had situations where debt has gone up and we've cut taxes at the same time. And interestingly enough, there's been some of the most productive growth times in the history of our economy. Go back to the 1980s, we added tons of debt to fight off the threat of the day, which was the nuclear arms race with Russia. We added massively to the debt, more so than we'd ever added to it before, and we cut taxes. So this idea that, well, if we are spending more, we have to raise taxes. We actually cut taxes back then, and the net effect was the economy grew like gangbusters. One of those productive times, one of the productive decades in history of the United States. So there's just really kind of a loose relationship between the two. But sorry, I could talk for hours on this. I'll just be quiet now. I see people falling asleep on the side. So
just that your historian is coming out. For those of you who don't know, Eric's a big fan of history in the country and does a lot of reading on that. And he's probably one of the best minds I've ever met on preaching on that stuff. So it's good stuff.
I'm not lots of fun to hang out with, but I know stuff.
Yeah, he's really fun at parties. You get stuck. Just a quick housekeeping item. So we're about 2/3 of the way through our allotted time today. I've got a handful more questions that were submitted, but just so we're coming up a little bit on the time that we had allotted. So if you do have any additional questions, please put them in that chat box, and we'll make sure to get them addressed before we wrap up today. So next question is it's actually a good one. It's one that somebody asked on the last call we had as well. How does Oxford? I'm seeing a lot about risk and risk tolerance and what does that mean? And there's different questionnaires out there. So how does Oxford view risk/risk tolerance, and should mine change at all as a result of this recent event?
Yeah, I think one of the things that we actually take a little different approach to this question of risk at Oxford as compared to a lot of other advisory firms. And what I mean by that is you have to do something to try to assess what someone's, we keep saying the word risk tolerance. Look, stocks are inherently risky. And that is also why they behave, they reward us for taking on that risk over time, but they are risky. They're always risky. I don't know if it's that they're riskier sometimes rather than others, but when things are going really well, people don't perceive stocks as being risky. And then when things aren't going well, people perceive stocks as being far riskier than they actually are. And so the firms, and there are literally thousands of them that use these risk tolerance questionnaires. They'll ask you 10 questions and say, if the market were to go down 10%, what would you do? And the answers are, I would pull out all my money, or I would stay pat, or I would buy more. And that's how these questionnaires are put together. I think they're absolutely ridiculous. They don't really measure what someone's true response would be when times get tough. Nor do they measure what someone's response would be when the markets are, having the kind of run they had just prior to the last few months, where it looked like, you could do no wrong and the markets are always going to go up. People will say, yeah, I want in on that. And so I think the risk tolerance questionnaires are basically a waste of paper. We do not do them at Oxford. We spend a lot of time having conversations with clients about what are your goals? What would it take from an investment standpoint to help you achieve those goals? When do you need the money? How much money will you need? And we build customized portfolios that reflect the knowledge we have from working with the client. And it's not something that's done in 5 minutes by an online questionnaire. But there are tons of questionnaires out there, and Lord help those people. I don't know, they don't work, but most firms use them.
One thing I'll add to that is, the question, part of that was, should I make a change to my risk based on what's going on? The way that we build portfolios, as Eric said earlier, is in anticipation of volatility, not a reaction to it. So the answer to should I change my plan, either from a risk standpoint or even just changing the investments, if your plan has not changed, then you don't need to change your investment. So again, as Eric said, we always start with a plan with clients and outline goals, whether it be retirement or something else. If you still have those same goals, which in the case of retirement, most folks do, they have a time they want to hang it up in a certain standard of living they're accustomed to. If you had a plan and an investment portfolio set up to support that, then you should stay the course.
Well put.
Next question is actually kind of tied back to our philosophy we touched on a little bit earlier. So someone said, I'm familiar with Oxford's stability bucket, growth bucket concept, which you outlined as part of an earlier question. What's the formula that determines when to refill stability and when not to, and what's the interplay between those two buckets of money?
Yeah, this is something, so our investment committee meets every month, and one of the standing agenda items is for those clients who are in withdrawal mode right now, someone's retired, is this or is this not a good time to refill their stability bucket? And so just a really quick example, if you set aside 5 years of your upcoming withdrawals into that stability bucket, well, what happens is, over the course of 12 months, that bucket has a leak. And we're sending out, usually monthly deposits into clients' bank accounts. And so we know that at the start of the year, we've got the bucket filled up with 5 years worth, but every month there's a little bit of a leak and a little bit of a leak. So that 12 months from now, you're down to just 4 years of stability left in your stability bucket. And so we sit down with a client with their annual review and say, how have things gone? Are you getting by okay on what we've been sending to you? Do we need to make any changes? Your needs increased or decreased, and we can make adjustments to the portfolio for that. But we have this central question of, is it time now to refill your stability bucket back up to 5 years? And, for the last, my goodness, 5, 6, 7 years, the answer has always been yes, every single month, because we've had some decent gains that we can take. So we harvest those gains from the growth bucket, and we use those to refill the stability bucket. And it's been something we've just done systematically. here in the past few months, we've had to revisit that a little bit in light of this, very severe, rapid drop in the markets. And so we took 1 month off. It was March, right, Pat? Where's April? I'm sorry. It was okay. Now you're on mute again. You're on mute.
At the end of March was the big decline. So it was actually our April meetings coming out of that March decline that we made that adjustment temporarily.
Right. And so in the month of April, for any clients who were set for review, we actually did suspend refills of the stability bucket. However, given that we also bounced back up about 30% in fairly rapid fashion, we went back in. And even for those April folks, we said, hey, that was a temporary decline. Doesn't mean it won't come back up, but we had a temporary decline. We've recovered enough that based on our look at valuations in the market, we think it's an appropriate time to actually go ahead and do that harvest for you. So we only took a month off from it and went right back in and refilled once markets made a fairly rapid recovery. And you didn't ask this, Pat, but I'll put this out there because, again, the media is not talking about this. The media loves to talk about how far down we fell, and it was a 30% drop. If you go back to February 19th, I think was the peak. We dropped 30%, and it was the most rapid 30% decline that the market's ever seen. It happened in very short order. But we also have bounced back up. And so now the narrative from the media has been saying, well, this can't be sustainable. We've come up too fast, whatever. My opinion of the media. But if you look at what has happened year to date, so go back to January 1st and say, hey, what's stock market performance been year to date? Reality is we're down about 12%. And so there's still a lot of, and it's the truth, but there's still a lot of headlines about, my gosh, the market's way down. And even though we've recovered some, it's still really bad. And it's probably fake anyway. And it's probably not going to last. If you go back 1 year ago today and look at where the market was, guess what? We're almost exactly where we were. Actually, we're a tiny bit up from where we were a year ago today. And so if you step back and have a little bit longer perspective on these things, yes, it was an incredibly steep decline. It's been a very unusual few months here. But on a 12-month basis, we're up a little bit. And of course, on a 3-year basis, we're up quite a bit. So it just depends how you step back and look at it. Does that mean we will or will not go back down? No, we have no idea if the market's going to take another tumble. If the market takes another tumble, it's going to be because something else has happened, information we don't have yet and that we couldn't see coming, that, the different virus outbreak, could be a war that breaks out in the Middle East, who knows? There's going to be some other external shock that would take the market down to 30% again. We don't know if that'll happen, but I just want people to have a little bit of perspective on it. On a 12-month look, we're flat, despite all this stuff.
All right, actually, so we're about quarter till, so I'll have some housekeeping items to close up. Actually, I have the last question here, so I'll ask one more time. If anybody has anything else, please submit through the chat box. This is actually the question we closed with last time. It's actually related to the 5th pillar of our investing philosophy. So the question is, this just feels, you mentioned some of the other things that have happened in the past, whether it was .com stuff or 9/11. This, because of it, really going back to 1918 was the last time we had an illness pandemic of this magnitude. This feels different than anything else we've experienced in our lifetime. So how does is anything permanently change moving forward? Getting back to that, it's never different this time. So how does this change things moving forward, if at all, in your opinion?
Yeah, so Pat's, and this is on our website, but Pat's alluding to we have these, the system we call Power of 5 investing, and number 5 comes up everywhere. The 5th pillar of Power of 5 investing is what we call the 5 words of wisdom. It's never different time. Sorry, my finger got stuck there. And has there been a global pandemic like this one? Not in 100 years, so that's pretty unusual. But every time we have one of these bear markets, there is something different that may not have happened exactly the same way before. So the housing crisis in 08 and 09, we had never had consumers having that much debt before. So in some ways you look at it and say, gee, I guess we should have seen it coming, but it was a unique thing. When 9/11 happened, that really hadn't happened before. You had Pearl Harbor in 1941, which is what led us finally into World War II. But we hadn't been attacked on our soil like that, and even the attack in Pearl Harbor was largely a military attack. To kill over 3,000 innocent Americans when they're on their way to work or they're in their office, that's never happened before. Was it different back then? Well, the particular event that happened was different. The market reaction was horrific. Actually, we went into a 3-year recession coming out of that one. That was pretty bad. And or in a 3-year stock market swing. So that was pretty bad. And it would have been easy to have said back then, well, this has never happened before. So I guess everything's different going forward. And the reality is the market adjusts, innovators go back to work, and we make productive things, and the market continues its long upward trajectory. I haven't found anything yet in all that history that has derailed the market from its long-term permanent climb. I don't think this is one of those things either, even though the particular event was, it was unique, or at least highly unique. It hasn't happened in 100 years.
All right. Well, that takes care of all the questions. So again, just a bit of housekeeping. So appreciate everybody's time being on the call today. As a follow-up to this, on Monday, we'll send out an email to all the attendees, which will have a link to a recording of this that we'll put on the website. You can come back and listen to answers to the various questions. We'll also have our white paper for coronavirus investing tips that we'll attach to that email as well. If anybody has any additional questions or something might be a little more personal that you didn't want to share through the chat or even talk about in this type of forum, please give us a call or shoot us an email. We're happy to discuss that with you on a more personal one-on-one basis. So turn it back over to Eric to close it up. But again, I appreciate everybody's time, and look forward to talking to you everybody again soon. We do have another webinar coming up in 2 weeks. We've got 2 more of these. I think I just took some of Eric's closing thunder.
That's why I was going to close us. So,
but we do have 2 more coming up. So 1, 2 Fridays from now, focused on how to hire a financial advisor. So either looking to maybe switch advisors, or you're looking to hire an advisor relationship for the first time, we've got some questions that you should ask each advisor to go through that. And then lastly, we've just got a financial planning one-on-one. So if you know some folks that have some basic questions, what is a Roth IRA, things like that, that one will be a month from now. So 2 weeks apart from the next one coming up here in a few weeks. So again, if you have any questions, let us know. Otherwise, I'll turn it back to Eric to close it up.
Actually, that was everything else. So I want to thank you all for some really great, insightful questions. That helps us a lot to have some material to go through. The next couple, I think, might be a little more, we may have more of a specified agenda on some things that we're going to cover. We'll announce those in advance and share those with people. I think the announcements have already covered that a bit. But again, it still will allow time for specific questions to come up during those sessions. So thank you all so much. I appreciate your time. And hopefully you're finding this format to be pretty helpful for you.
All right. Thanks, everybody. Look for that email on Monday with the recording and the follow-up. And please let us know if you have any questions. Thanks so much.
Thank you.
Have a good weekend. Stay safe.